Welcome to the Independent Advisors Podcast, where we dive into the world of stocks, tradable markets, and financial planning with Jessup Wealth Management's Chief Investment Officer, Mark McEvely, and CEO, Matt Jessup. You'll hear tips, tricks, and strategies to address your financial well-being, and most importantly, conveyed in a way that everyone can understand. Here are your hosts, Mark and Matt.
Hey everyone, welcome to episode 256 of the Independent Advisors Podcast, where Matt Jessup and I, Mark McEvely, bring you everything you need to know from the past week in the world of financial markets and financial planning. This week, we are deviating from our normal format and bringing listeners along with us to the Portfolio Summits Conference in Columbus, Ohio on June 6th. Portfolio Summits held an Ohio RIA advisor-only conference where I moderated a panel to discuss the market's hottest topics with industry leaders. In just a few seconds, you'll hear opinions and strategies from our expert panelists, including Edison Bizicka, Sky Berry, Peter Klingelhofer, Andre Breet, and Travis Upton, and myself. We hope you enjoy this discussion. Before we dive into the panel, let's quickly review the month-to-date and year-to-date performance of the major indices that we track. This data is from YCharts, and as of the market close on June 11th. S&P 500 index is up 1.9% for the month and up 12.7% for the year. The Dow Jones Industrial Average up 0.2% for the month and up 2.8% for the year. The NASDAQ Composite Index up 3.6% for the month and up 15.5% for the year. The Russell 2000 Small Cap Index down 2.5% for the month and flat on the year. And the Vanguard All World Ex United States ETF down 0.6% for the month and up 5.2% for the year. The 3-month Treasury rate sitting at 5.52%, the 2-year Treasury rate 4.81%, and the 10-year Treasury rate at 4.39%. What you are about to hear is an investment panel discussion that I moderated in June with professional portfolio managers. We discussed the higher for longer interest rate environment, earnings volatility, multiple expansion, optimizing portfolios, and AI. In the spirit of keeping our podcast episodes 30 to 40 minutes, we put together the highlights of this discussion that we feel are important for listeners to hear.
Have we achieved peak profit margins, do you guys think? I know I've been hearing this for several years now, that profit margins can't go any higher, but obviously they have. So are we near that, or what are your guys' feelings on that?
I mean, so for a profit margin standpoint, I track Home Depot and Walmart as my two bellwethers, right? I think tracking those profit margins, how well they've actually pushed those down, it's been quite impressive over the past couple of years. I do think we're probably at that peak profit margin threshold. We go back to your point earlier, the why is the Fed going to cut? I think that's going to be the dictating factor for those to go down.
That's your...
I think I would agree, actually. I'll interject here. I've been sitting quietly. But so we, for instance, track credit card data in the US. Millions of American debit and credit card data. And something that we picked up recently is an interesting reduction in the transaction spend per visit of multiple outlets in the US. Walmart and Home Depot are good examples, but you can look at the type of spend and the type of consumer who spends where, and at what outlet or supermarket or retailer they actually spend. And the spending has come down, and I think there's a threshold after which consumers are not willing to spend or unable to actually spend, and therefore the companies just simply will be unable to extract as much margin as they were in the past. Now this obviously ties into the macroeconomic cycle, high credit card delinquencies, interest rate on credit cards having gone up from, call it 14-15% to about 20% now. And I think there's going to be a threshold after which margin compression is definitely going to set in.
Yeah, thank you, Andre. And kind of staying on this topic, I want to talk about multiple expansions. And Peter, I'd love to get your thoughts on this. You know, we all know that multiple expansion happens for several reasons, right? Improved growth outlook, lower risk perception, industry trends, monetary policy. How do you balance the potential for multiple expansion with the risks of overvaluation?
Yeah, it's a bit of a challenge because you've got sort of cyclical multiple expansion, which is unlikely to be sustained, right? But then you've got secular multiple expansion, and I'll kind of distinguish the two if you think about it between Nvidia and Microsoft, for example. If you think about what Nvidia has done of late, obviously there's been a changing perspective about what the addressable market's going to be, right? The acceleration of AI, bringing some of it forward, has really just driven Nvidia's earnings straight up. But if you think about the starting point, right? Nvidia was at a cyclically depressed moment, not that long ago, right? The stock was at 350 bucks, the peak in 21, and just 12 months later, it's around $100. So timing on that type of thing is really important, because if you're late to the game and you buy it at 350, yeah, it's nice. It's a triple from there. But you make 12 times your money through yesterday if you bought it closer to 100. That would be perfect timing, of course. But to get multiple expansion, if you think about it, there's a cyclical component. You're depressed, your margins are low. At that point in time, Nvidia had very low margins. I don't think the outlook was anywhere near what it's turned out to be. And actually, Microsoft helped them get there, because it was Satya Nadella stepping up and basically buying ChatGPT to accelerate this, right? And that was the fundamental change that was really the kicker, the real driver. There's depressed valuation, depressed margin, then you get a fundamental kicker. And this is actually, probably for many of us, gotten more elevated than many of us thought it could get, right? Well, let's distinguish that between Microsoft, where it was 12 years ago where Microsoft was a washed out stock. And I was a portfolio manager managing a large cap value fund at the time, and the person I reported to laughed me out of the room one time saying, "Why do you have this in your top 10? This is the new GM." I mean, they were trading at 10 times earnings, and people had written them off, largely because Steve Ballmer. So this is kind of talk about cyclical low points. There's no confidence, right? That's another part of margin expansion. You have confidence and belief. It took Microsoft 6-7 years from 2010-11 to 2016-17 to get its multiple up to the market multiple. And it was just a market performer during that time. It's not until their market multiple got to like 20 times that it actually became a strong performer. And that tells you something about psychology of markets. People want to own the leaders, right? And they don't care about the valuation they pay if that company's a leader and they can sustain it, right? And Microsoft has not traded below 20 times since 2017, 2018. It's never really given you a really great valuation opportunity, but they are hitting on all cylinders in terms of the AI future, and they're maintaining margins. And I think that's where it comes down to. It's sustainability of margin, right? Nvidia could have a weak quarter 3 or 4 quarters from now, and their margins could drop 1,000 basis points very quickly, and people will run for the exits sharply, and it will create volatility, and it could scare some investors away, and you could have that move from 350 to 100. Maybe it's 1,200 to 800 this time, but that'll hurt some people, right? Microsoft hasn't got that same type of variability. So I think a lot of people will crowd into that as more of a safety or quality play. But there's other components of multiple expansion that are very cyclical. And hopefully when we get through the next sort of downturn and margins fall off, we'll be able to buy a whole bunch of cyclical companies at very attractive multiples and enjoy another multiple expansion run.
All right, so for those people that might have missed the Nvidia trade, what are some regions or sectors that you expect significant multiple expansion in over the next 5 to 10 years? There are some opportunities for people.
Well, from this point, that's challenging, right? Because we're sort of at a peak margin level. I think this is where you have to think about fundamentals and sort of get yourself lined up on what should do well over the next 5 to 10 years, and what do I want to buy when I get a chance, right? Within technology, one area we're very interested in is cybersecurity. There aren't that many direct cybersecurity companies that are very meaningful in terms of market cap. And if this next segment of AI gets released into the wild, I'm participating in a University of Colorado Strategic Advisory Board on AI, and we had a meeting recently, and the CFO from a late-stage cybersecurity company that should be coming public in the next year or two told us on this call the other day that his engineers have showed him what these large language models do, and if that's released without the proper protocols, the need for cybersecurity is just going to accelerate. So that's an area where we think at the right price, there's still a lot of runway, if you will, within tech. Other areas of the market that I think we'd be interested in would relate to infrastructure, but those multiples have already anticipated a lot of it. So we're waiting for sort of a misstep to get, well, I think there's a long runway, but I think we're overpaying for that opportunity right now. So,
yeah, thank you very much, Peter. Travis and Sky, I want to talk a little bit about the lost decade. From 2000 to 2010, it's often referred to as the lost decade, where the S&P 500 did not make a new all-time high. During this decade, there were multiple challenges: the tech bubble, 9/11, the great financial crisis. 3 questions for you both. Number one, do you think history could repeat itself? What are the biggest risks on the horizon for investors? And are there asset classes that worked in the early 2000s that could work again if we go through a similar market cycle?
So I think a lot of people forget about that last decade when thinking about the US, because our memories sort of are short term, and when we think about, if we can remember 3 years back, that's sort of how far we predict. So the US has been on this 15-year bull market, and people tend to forget that there are these seismic cycles that do certainly happen. And on any objective measure, the US, from a valuation perspective, is stretched. And so where are opportunities outside the US? We're certainly looking outside the US. I mean, to your point about Nvidia and Microsoft and their multiples and valuations, for the top 7 valued companies in the United States, Magnificent 7, the top 7 or 8, you can essentially buy the entire London Stock Exchange, all the companies on the LSE, and all 6,400 companies on the Tokyo Stock Exchange for the same price. It's hard to say whether the US will enter another lost decade, right? I think there's so much productivity growth. There's still a strong consumer. The Fed's trying to do what they can to keep the economy, from really suffering from a hard landing. But internationally, from a non-US perspective, there are opportunities for long-term growth, whether that be margin expansion or simply, from a US perspective, benefiting from the dollar, which is now pretty high, coming down slightly. So it's not to say we would overweight. The US we certainly wouldn't. It's not to say we would overweight international. We certainly wouldn't underweight US. And it's a great diversifier. In 2022, the international markets did outperform the US, but that's a short period of time. We're looking at these long seismic shifts of decades of time. And it's really difficult to predict from today that the US will do what it's done the last 15 years from this point today for the next 15. Hopefully it's not a lost decade, but I think looking outside the US is important.
Travis?
So I'm going to answer that. I'm going to tell a little personal anecdote, and then I'll directly answer the question. So when you bring up the lost decade, my first opportunity managing portfolios in my career, I worked for a regional bank from 2001 to 2004. And so coming into that role, the core discipline of the bank was this quality growth, kind of growth at a reasonable price. So very growth tilted coming out of the tech bubble. And the bank was making a number of acquisitions and acquired a value manager, which also came with some small cap exposure. They acquired some new international tools. And during that time, because I was the young guy, on the team, I got all of the mutual fund asset allocation portfolios, because those simply weren't as fun in the trust department as the stock picking portfolios. And during that period, the mutual fund portfolios that I had the opportunity to oversee actually were some of the best performing in the region. And that had nothing to do with my investment acumen. Quite the contrary, it was because during that period of time, the real value add decision was having international exposure, having dividend exposure, and having small cap exposure. The value add decision was not, do I pick Home Depot or Lowe's to round out my consumer discretionary allocation? So that was something that was very formative for me in my portfolio management career. And when you ask about that lost decade, because this was the start of the lost decade, I actually think there's some things that rhyme today that rhyme with that period. And the three things that were really the big value adds during that period, number one, was value and dividend stocks. And I think that's an area that's cheap today. Small caps is also an area extremely cheap today. Relative valuations, you look at the charts, they look today like they did in 2000 at the start of that period. I think the thing that we're lacking right now, though, is what's going to be the catalyst for outperformance. And we've actually heard it on this panel a few times today. I wonder if AI, profit margins, and right now we're very much in an AI cycle where it's the AI producers, the Nvidia of the world. I wonder if when the market shifts to the AI beneficiaries, that's something that could be a catalyst for some of these other industries, dividend payers and small caps. So that could be huge. And then Sky, you mentioned international. And that's something at our shop we've been having a lot of conversations about recently. And I was actually looking at this morning before coming in here. If you look, Scott, I think you mentioned 22, international actually did better than US stocks. It's actually interesting this year when you dig under the hood, if you look at the currency hedge EPA, I think it's up about 14%, 12 and change for the S&P. The stocks themselves, when you look at Japan overseas, are actually doing better than stocks in the US, Nvidia included. The big drag is a strengthening US dollar. And that's something that happened during the last decade. You lost money in the S&P for those 10 years. You did okay if you were in dividend, small cap, and international. And for international, the big tailwind during that period was a weakening dollar. I think we've all seen the charts. International is cheap, historic PE discount. We're actually seeing some of that narrow a little bit with stock performance. You're seeing international stocks that are actually earning. But if we were to actually see the stronger dollar become a weaker dollar, and for international, that headwind become a tailwind, I think you could see some of those asset classes that worked in the last decade work very well for the environment that we're heading into.
Yeah. What about emerging markets like China? So China, just over the past couple of months, has been really strong. Some are calling for a bottom in Chinese markets. Emerging markets is another area that fundamentally has looked very attractive for a long period of time, but as you kind of alluded to, Sky, on a relative basis, the U.S. has outperformed emerging markets significantly. So what are your thoughts there?
Emerging markets is interesting. The standard deviation, the difference in valuation between the US and emerging markets is it's north of 3 standard deviations, which is exceedingly rare for any market. We're currently looking at, we have a small position in emerging markets, small cap, which is about as risky as it gets. And the pure driver there is diversification, right? They have that small cap, sort of high octane performance opportunity, but bringing diversification to the portfolio is essentially my take on emerging markets. We're not removing China from the investment equation. I think making a bet like that, while it's a small position, making a bet like that is not something we try to predict, right? Whether one country is going to do well versus another. Essentially, the emerging market thesis is their ability to adopt technologies and productivities that other countries, developed market countries, have either developed and taken time to adopt, they have this ability to leapfrog other economies and simply instill those technologies or those productivity drivers and benefit from them. Essentially, the demographics right in China are something that's a huge growth driver. 350 million or more middle class just rising through the ranks. Of course, politically, that's a challenge, but also something that I think is really hard for us to predict outside of China. Data is somewhat unreliable, as I'm sure everyone's aware. It's really hard to trust GDP figures and things like that until you really see it translate on the ground.
Yeah, thank you for that. And it wouldn't be an investment panel in 2024 if we didn't talk about AI. So let's talk a little bit about AI, and specifically for Edison, Peter, and Travis, and then I want to get to Andre on some of the data. Again, it doesn't seem like this theme is going away anytime soon. So how are your firms positioning in this space right now? And what does the future of AI look like other than just an investment perspective on Nvidia?
Well, so this is a great question, right? I think this dichotomy of like high valuations, but do I really need to own it is a battle that I think everyone is battling with right now. The reality is, if the AI space isn't going away, or the theme, it really reminds me of the 3D printing craze from like 2011 to 2014. Remember that, the bubble that burst in 2014? It's the same kind of structure, but a little bit more profitable today. Investing in AI, I think the first critical thing to note is you have to drive both portfolios and client mentality away from Nvidia and into an AI asset class, so to speak, right? And if the reality is that you want to be invested in that asset class, it's really important to know the why and the how you're going to approach that. Because Nvidia is obviously in the headlines. The way we approach this space is we have built kind of essentially an AI portfolio, but not only with the Nvidias of the world, but the suppliers to Nvidia, the suppliers in mid-cap and small-cap space, with the reality that it needs to be a 5 to 10 year play, because the reality is there's going to be more volatility, there will be margin compression, there will be some sort of volatility cycle when an earnings call is missed over the next 2 or 3 quarters. The reality is you can't not own it to some degree. You just have to be very intentional in how we approach that. So that's our pitch. And to be frank, typical household for us, probably no more than 7 to 8% max within that space is kind of how we approach that at this point in time from a diversification standpoint.
Great. Travis?
2 things that I would say there. One is we're having a lot of conversations of when does the market shift from looking at the AI enablers to the AI beneficiaries. And I kind of alluded to this earlier, but what is AI going to do to the cost structure and profit margins of other industries? And just to give an anecdote, I had a great conversation, this was probably 3 weeks ago, with someone talking about the healthcare space and what AI modeling is able to do for drug manufacturers and how that may be able to speed up the research process, speed up the time to market. And that's an area where if you look out right now, healthcare is a pretty beaten up sector, but if that's something that we're going to be able to push new drugs to market faster, that can become a huge tailwind for some of the pharmaceutical companies. I don't think that's being talked about in the mainstream. One of the other things I'd say, something that we're doing right now, Pete, I think you brought it up earlier, but is cybersecurity. We have one aggressive portfolio that has a thematic sleeve. We have a dedicated play in cybersecurity in that portfolio, really for the reasons that have been expressed here. I don't care what your views are with AI. I think that as AI expands in its usage, the need for cybersecurity, the demand for cybersecurity, I think that's kind of low-hanging fruit because that should have huge demand growth.
Anything to add, Peter?
I just think whenever you're going through a mania in something, it's important to maintain some perspective because really we're always reminded there's nothing new under the sun, right? I mean, there was a biotech craze in the early 90s, and then there was the tech bubble, and every one of these things is generally a misallocation of capital, eventually. You get to a point where too much money went after this opportunity, and the sheer amount of money thrown at it means that forward returns become poor, and then everybody disappears, and they find something else. And if there are beneficiaries of it, they'll go there. But if you think it took a while after the tech bubble for people to find something else, and then they found that China was going to devour all the raw materials, and we had an energy and material cycle that rippled through the global economy and helped countries like South Africa and Australia a lot. I think the thing that I'm sort of thinking about this time is that now when you see Jensen Huang on TV, it's just like when John Chambers was on TV. I remember John Chambers saying, it's no longer the big versus the small, it's the fast versus the slow. And Jensen Huang the other day, I saw him maybe a month or so ago say, we need to think differently. Maybe if you're telling your kids what they should major in, maybe they shouldn't major in coding. They shouldn't major in coding because we're going to develop such chips that we're not going to need coders. That's how we need to be thinking. And I'm like, that's pretty far out there to get beyond needing coders, okay? So when people start talking like that, I think you're getting kind of closer to the end of it. But of course, when you're living through it, 6 months is forever. And if you've made a call on Nvidia at 600 and now it's 1200, you look really stupid. So that's what we have to keep in mind, and that's where perspective is important. And I think it's going to be interesting, but we'll see a year from now what we're talking about. But I doubt it's going to be AI.
Andre, kind of switching gears here, since you're a systematic quant manager, how is AI changing the data analytics quant side of investing, and how can we leverage AI with big data into our trading processes?
By leaps and bounds is the short answer. I can muster, I think, an answer about AI and stock picking and which stocks enablers, etc., but that's not the point. So AI is something that we use every single day at CFM. We've used it extensively to test models, to test predictors, to test previously fundamentally held beliefs in the market. The use of AI is really unlimited by, at this stage, your imagination. But I should add, the story of AI is really the story of data as well. So the enormous growth in the amount of data that is available and will continue to grow is beyond any analyst or any army of analysts to be able to not only digest and to analyze that data. Now, we can be accused of being biased, but as a quant firm, we believe that more data is better than less data. And the more data you can digest, clean, inspect, analyze, etc., is going to give you some sort of informational asymmetry in the market. So AI and data goes hand in hand. You can use all and any data that is available, either publicly or you go get it through private vendors to give you a sense of where the world's going. We're talking about global opportunities, as this panel was talking about. We've actually not talked about any of the other asset classes. For instance, I think we live in a world, some people call it the polycrisis. We haven't talked about, we've talked about China, but what's the implication of China and Taiwan? What's the implications of weather changes to commodities and agriculturals and softs? What's the implication of potentially higher rates and inflation? How US consumers are going to spend? We haven't talked about, for instance, the need for the green transition in terms of electrification, etc., etc. But in this world that we are moving towards, which is a complicated and messy world, and an uncertain world, in many respects, AI and the use of this combined with the data can give you a very interesting leg up. You can find interesting relationships not only between asset classes and between asset classes and, say, geopolitics, but it is a process that can run by itself and it can find non-linear relationships or the emergence of non-linear relationships and patterns. There's no analyst that you can take all the analysts, all the banks, that will not be able to do this. But if you have the tools and you know how to use the tools and know where to find the data and how to clean the data, etc., I think it's an invaluable tool. Again, being biased is obviously it's my crime, but I think informational asymmetry in the future is going to either make you the winner or the loser.
And Addison, really quick, are you guys leveraging AI right now in your firm? How so?
Yeah, so data is the key to AI, as you very well pointed out. And for those of you that do own your own and run your own RIAs, right, owning your data is so important. One of the ways that we're approach this pretty well is we have our own AWS contracts. We utilize a lot of Redshift instances from Amazon Web Services, where we have taken our Orion data, our Salesforce data, our Redtail data, our eMoney data, all into one single database, and be able to control that from one entity and be able to run and analyze that data and effectively data. What that allows us to do is not only own our own data warehouse, own our own data in true capacity, but automate roughly the 50 to 75% of tasks that we all do every day that may be repetitive in nature, kind of wiping that slate clean for analysts, for operations staff, things of that nature. That has been a tremendous value add. We're probably about a third of the way through that process right now. It has been very intensive, yet the benefits are, from a productivity and capacity standpoint, have been quite substantial already.
Great, thank you. Well, we're at that point where we have a couple minutes left. I'd love to open it up for questions from you all. If you want to ask any of our panelists anything that's on top of your mind.
I can just shout. So my quick thought, I want your quick thoughts on, I don't know who to ask specifically, on AI implementation into our practices every single day when it comes to market positioning. What I mean by that is, look at passive investments, Vanguards of the world that, own so much in assets are positioning in their stock 20-30% ownership of the bank, right? Vanguards of the world. I like to say AI is going to make the world markets efficiently inefficient, too efficient, where everyone owns the same stuff, positioning the same way. Hedge funds are using the same data, similar data, to position around the markets. And if everyone's positioning the same way, digesting the same information that's out there, using the AI to position, how are we ever going to be able to make discrepancies in the market when they're all supposed to be efficiently efficient?
Anyone want to take this? I know Andre and Addison were chatting a little bit about this before the panel started.
Yeah, so I would take the opposite argument on that, in that if you look at capital market expectations across every major bank, every private research firm, so on and so forth, the next 15 years will drastically different, say for U.S. large and mid-caps, than they ever did in the previous 15 years. I think from a passive to active structure, AI is actually going to enable more active management, I believe, than the passive structure, where we're likely to see a notable influx of money from passive into active. It could result in what you're referencing, like everyone owns the same things because our algos all look the same to some degree, right? And alpha decay just becomes like this norm. But I do think there's a lot more capacity there for active management under that structure. Maybe we all get really creative in how we approach it. And I think what's going to lead to is probably more of a normalization, where you're not everyone's overweight large cap, right? The large, mid, small space maybe becomes one bucket, which is kind of how we think about the investment world. I think it's going to enable a lot of that thinking. But it could certainly go both ways. I'm not going to, no crystal ball in that case.
Anything to add there, Andre?
I think I'll take a stab at it from our perspective. So alpha decay is something well known, crowding, something well known. We obviously have systems in place to test for this. There's statistical ways that you can determine whether there is some alpha decay happening or if there's some crowding. I think people throw this term AI and LLMs very easily and very loosely. There's a million ways that you can use. Let's use the example of LLM. So you apply an LLM to a set of Federal Reserve documents. There's a million ways that you can prompt AI or teach AI or make it learn on these documents. But if you only feed it this document, it's only got this particular reference point. So it depends on how it's being used. It depends on how it's being prompted. It depends on what underlying corpuses, in the case of LLM, it's being fed and it's being trained on. And that introduces a large degree of variables in making AI give you an answer, to give you some sort of output, whatever you wanted. So from us to some of our peers, there for sure be some overlap in use of it, but the way that you fundamentally teach it, say, and the way that you fundamentally add additional data, and what data you add is going to basically increase the spread of the outcomes. So it's not something that I think is going to necessarily get us to a place where markets are exceptionally efficiently.
It's interesting you guys think the alpha disparity is actually going to be bigger. That's interesting.
Don't quote me on that.
Really quick, I think we had another hand up back here. We just have about a minute left.
I'll shift my question a little bit because I was going to go on those lines, but I'm just curious on emerging markets, your thoughts on India, with Modi not having the authority anymore, like what the outlooks might be, if you have any for India, because I think largely people have been pretty positive about their future. I don't think anybody has thoughts on that.
Anyone want to take that?
Does anyone else have this?
We have a position in emerging markets, and we like the opportunity longer term. And I think India has not done as good a job on the infrastructure front as China did. But going forward, our belief is that that opportunity could play out a lot differently, and it's still, there's 1 billion people, right, or close to it. And we sort of see this as a long-term opportunity, but our valuation work says, a lot of people have now kind of overvalued India short term. But we're a bit like Sky in how we look at emerging markets. We're not going to exclude one country versus another. We make more of a total asset class investment when we do it.
Yeah, thank you. Well, that's all the time we have for today. So thank you to our panelists, and thank all of you for coming and listening to us today. And hope you have a great rest of the day here. Thank you.
Advisors podcast. If you're interested in hearing more, hit the subscribe button so you can be notified every time a new episode gets released. Feel free to share with friends, family, and follow us on Twitter at Jessup Wealth, Facebook, and LinkedIn. Mark and Matt will continue to share beneficial information on these social media sites. Also, check out the podcast tab on their website. That's www.jessupwealthmanagement.com. There you'll find links to every episode of The Independent Advisors. Have questions or topics you want to discuss on the show? Message us on Twitter, LinkedIn, or send an email with the words questions and topics in the subject line to inquiries@jessupwealthmanagement.com. We'll talk about it right here on the podcast. Certain sections of this commentary may contain forward-looking statements based on reasonable expectations, estimates, projections, and assumptions. Forward-looking statements are not guarantees of future performance and involve certain risks and uncertainties which are difficult to predict. All indices are unmanaged and are not available for direct investment by the public. Past performance is not indicative of future results. This podcast is provided for general informational purposes only and does not constitute either tax, legal, or financial advice. Although we do go to great lengths to make sure our information is accurate and useful, we recommend you consult a tax preparer, professional tax advisor, financial advisor, or lawyer regarding your specific circumstances. Investing involves risk, including the loss of principal. No strategy can guarantee any objective or goal will be achieved.